Hi, my name is Stuart Wemyss and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And for a change, I'm going to share a case study episode with you today. I haven't done a case study episode since earlier December, I think. So it's been a while, but I've been trying to get through all the listener questions. And I'll continue working on those, but every so often I'll throw in a case study episode. And just for people that haven't listened for a while or maybe have forgotten, the whole point of these case study episodes is to share how the methodologies that I talk about and principles that I talk about in the usual Wednesday episodes, how they play out in real life by sharing some examples of some clients that we work on within our business. Okay, and the theme today is really around perpetual portfolio. Now, I spoke about this in July last year, episode 314 to be specific. The title of that episode was How Much Super Do You Need for Retirement? And in that blog or in podcast episode, I talked about the concept of a perpetual portfolio. So a perpetual portfolio is really a portfolio that gives you access to sufficient wealth to fund living expenses, but invested in a way where the value of that portfolio continues to grow, hopefully by more than inflation. And so in real terms, you can mathematically afford to live forever. You're never going to run out of money. And you're in a situation then in retirement where your investment assets are still compounding, still improving in terms of value. And I think that gets you into a sort of very comfortable position rather than necessarily eating away at the balance. And this case study sort of highlights that. So I started working with these clients in mid-2017. And in fact, the client approached me really to look after his self-managed super fund. The client, him and his wife, they just retired. I think the wife retired earlier than he did, but he's just entering into retirement. He was 60 at that stage. And he had a self-managed super fund with about $2 million in it at that time. And that $2 million was broken up, about 650 in direct ASX shares, about 12 different holdings. I had 557,000 in two managed funds, actively managed funds, and about $770,000 in cash. And the impetus for him to reach out to get advice was that he had invested a very large sum of money in a particular stock that really didn't work out. In fact, it went down to zero pretty much. And so lost a substantial amount of wealth and probably at that point realized, hey, I better go get some advice, especially since he had a lot of money to invest. He's just starting retirement, had a lot of ambitious travel plans. So realized the expenses were going to be high and the investments needed to be quite prudent. So in addition to the $2 million in a self-managed super fund, the client's home was worth about 2.5, had a holiday house for about 850. Not that those two assets are meaningful to mention because obviously they're lifestyle assets. And then an investment property in Ashgrove in Brisbane. It was worth back in 17, $750,000. Had $230,000 of debt, so about $520,000 of equity. So really $500,000 in the investment property, $2 million in super, $2.5 million of investment assets. So if we fast forward about 7 years, well, it's been really 7.5 years, I guess. At the moment, the super funds balance is about $2.13 million. So a little bit more than what it was in 2017. I'll say it now, in fact. The client's been drawing on average between $130,000 and $150,000 of pensions out of his super fund for the last 7 years. So despite that, the balance is still higher, which is kind of good news. The holiday home and primary place of residence, hasn't really changed that much, increased a little bit. Combined value is about 3.75 million. 7 years ago, it was about $3.3 million. Unfortunately, those assets in Victoria over the last 7 years, in real terms on a median house price basis, has gone backwards. Ashgrove has done really well, as you would imagine, because the Brisbane market really started to improve about 6 months after we started working together, which was kind of perfect timing. So Ashgrove's probably worth about 1.65 now. It's got a little bit more debt because the client gave one of his children a large sum of money I can't remember, $500,000, I think it was. Anyway, so that loan's 875. He was able to restructure some debt. So it's got about $1 million, a little bit, nearly $1.1 million of equity. So the equity's kind of doubled over the last 7 years. Kind of good timing from that perspective. So his net investment assets, $3.2 million. So they've increased by about $700,000 over the last 7 years. The clients are now, he's 67 and his wife's 63. And so we worked on a number of different things over the last 7 years, which is a relatively short period of time and a pretty choppy period of time, if I may say so. So we met mid 17, probably would have started working on, by the time we did all the advice and plan and whatever, in the second half of 17, started working on the investments. And then a few years later, well, around that time, 18, there was the banking tax because the banks got really smashed and he had a lot of exposure to the banks. Then we had COVID, and the share market during COVID was, well, it started off as a bit of a crash and then it sort of recovered and then it lost a bit of ground, then recovered. So it's been a choppy period of time that last 7 years. We really haven't had a clear runway. But over the last 7 years, we gradually divested of the active managed funds. So this is a really interesting and important point. The client held investments in a Magellan Global Fund and a Walter Scott Global Fund. Walter Scott's run by Macquarie Bank. Anyway, they had these actively managed funds that actually had performed when we looked over the last sort of 5 to 7 years before meeting the client. They actually had performed quite strongly. And it's difficult, right? When you have an investment that's done well, but you know it doesn't really have the fundamentals necessarily to continue or repeat that performance. It's difficult to turn around to a client and go, we should sell these assets. And it's counterintuitive, if an investment's done well, it's counterintuitive to clients to go and sell them. But actually looking, doing some work for this case study episode, looking back over the last 7 years, Magellan has underperformed the index by 1.8% per annum, compounding, and Walter Scott has underperformed the index by 1.4% compounding. So in reality, if we look back, because, when we go and sell an investment, not everyone always looks back and go, well, was that the right decision? I very much like to do that because I like to learn from my mistakes. If, we didn't make the right decision or we could have made a better decision, let's learn about that. Well, when we look back now over the last 7 years, that was a good decision. We still own a little bit of Walter Scott. We've only been gradually divesting, but I think it's probably time to let all of that go now. But I recorded an episode in January talking about active versus passive and the benefits of that, and just making sure if you're going to pay high fees, both those funds are charging 1% or more per annum in terms of for their advice. Well, you're really paying that 1% per annum to lose somewhere between 1.5% to 2%, less performance. So, you're out of pocket by about sort of 2.5% to 3%, including fees. So looking back, that was the right decision. We also implemented what's called an income equity strategy. It's not something that I use widely, but the client was, it really suited the clients, both in a risk profile perspective and understanding the risks. And an income equity strategy is we want to invest in equities mainly for income. So we're talking really about sort of high yield ETFs. Vanguard has Vanguard Australia High Yield ETF. It's quite a good fund. It's performed really well. And if you look over the last sort of 5 years, because Vanguard doesn't really publish 7-year figures, and we haven't been on the platform on a wrap platform for the full 7 years. But so when you look over 5 years, that income equity strategy has delivered about 6.5% grossed up in terms of income and about 4% growth. So you've got 10% return there, but skewing more to income. Now, normally when we invest in equities, it's not really predominantly for income, but we've changed the allocation in his portfolio a little bit to tilt towards income, knowing that he, particularly in the early years of retirement, I think this would be common for many people. In the early years of retirement, the clients were really keen to do as much traveling as possible. So their draw on the portfolio is going to be higher in the first 10 to 15 years of retirement than, say, in the following 10 to 15 years. Of course, as we get older, probably less travel, all those sorts of things, of course. We have also invested about 10% of the super fund's balance in direct corporate bonds. And that allocation has changed over time. It's currently just a little more than 10%. And again, that's allowed us to try and manage the risk in the portfolio, by selecting which investment grade corporate bonds we want to invest in and achieving better returns, both from an income perspective, and we've also got a little bit of capital growth from that strategy. We also have about another 10% invested in other bond ETFs, quite long in duration. So duration is the time to maturity, and the longer the time to maturity, typically the higher returns. Not always true, but so we've got some defensive element in his portfolio, but again, still really focused on maximizing income and trying to manage that risk. The client still has some direct shares. Remember, I said when he approached us, he had 651,000 in direct shares, about 12 different holdings. Well, there's about 8 holdings now, 7 or 8, and it only makes up about 10% of the super balance now. So gradually just been taking profits. And, again, based on that evidence-based approach of using index funds or rules-based strategies, I should say, low-cost rules-based strategies, to invest in share markets. Of course, when clients approach us for advice, they might have these legacy investments. They might have been investing in the share market for a long time, and they've got some direct stocks. Well, we feel like it's probably too aggressive just to turn around and sell everything and then reinvest it in index funds. We think we tend to take more of a strategic approach. So there might be stocks in there that if we think they're overvalued, let's take some profit. If you've got some CBA, let's sell CBA today and hopefully sell it at a relatively high valuation. Whereas if you've got BHP, a little bit unloved at the moment, probably not a seller at this price point. So let's hang on to it, enjoy the dividend, and we'll strategically divest of that stock, maybe if ever it gets back to $50 a share again or something like that. So we'll be a bit more strategic about it, which is a little bit more hands-on, but we feel like that really helps maximize value. So at the moment, those direct share portion, we've obviously never added to it. It was just that portion from 7 years ago. We'll continue to make some changes. Maybe we'll never get down to zero, but that's okay. It's not making up a large part of the portfolio. And so if one of those direct stocks underperforms, we don't really have much exposure. It's not really going to skew the returns on the portfolio very much, which is really critical, I guess, when you're in a retirement phase and you really want to try and maximize the returns over that period of time, particularly in the earlier years. And back in 2017, the client was very keen to sell Brisbane. I'll get into that a little bit more in a second, but very keen to sell Brisbane. And I said, no, we don't want to sell it. I think that Brisbane market's going to turn around, and encourage him to hang on to that property. So again, in hindsight, that's a good decision. Sometimes, the good quality advice, sometimes it involves doing something like divesting of those active funds. Sometimes good advice is just don't do anything. So you don't necessarily think good advice has to always result in an action. It can actually result in inaction, and that can be just as valuable, sometimes if not more valuable, than making changes. And that's just something, I guess, an observation that sort of comes out of these case study episodes quite regularly. We only moved all the investments onto the platform sometime during 2020, even though we started working together in 2017. That's a long story around why there was a delay, but neither here nor there. But if you look at returns since inception, they're just about 10%. So over that sort of 4-ish year period. So the returns have been quite good within the portfolio. Now, as you know, I like to reflect on these case study episodes and, just reflect on 3 or 4 different things or points that we can all learn from it, because I'm sharing this case study, but what can you as the listener learn from it? And I think these things are really valuable, right? That's how the best learnings are just don't repeat other people's mistakes, and the things that they've done well, just do those things well, right? You don't have to reinvent the wheel, just follow that learning. So let's reflect on that then. So the thing with a perpetual portfolio, if that's my aim, is I want this perpetual portfolio so that this client, for example, been working together 7 years, I imagine he feels really comfortable now, knowing that, hey, if he spends 150 grand next year on living expenses and travel, that it's all okay, that his portfolio is moving in the right direction, gives him a large sense of confidence. So if you do want a perpetual portfolio, which we want for all our clients, of course, we really need to make sure the assets are going to work hard for us. So really, it's about critically looking at every investment and asking ourselves, what contribution to future returns will this asset make? And in a situation where we're uncertain, we then need to proactively make changes to that investment so that that is gradually divest and reinvest elsewhere. Also, it's really important to have a good mixture of income and capital growth. Now, you might get that in the same investment, like we have enjoyed with the high yielding funds, but you might get them in different investments. So, for example, we've got direct corporate bonds. There's a little bit of growth in there, but it's mostly about the income yield. And then we've got Ashgrove, the investment property, and that's all pretty much all capital growth. I mean, of course, there's rental income and so forth, but in terms of where all that returns come from, it's really the property increasing in value from 750 7 years ago to 1.65 million today. And again, if we sat back in 2017, we asked ourselves, would it be worth 1.65 million today? No, I think most people would have gone, no, that's too ambitious. Of course it could, but it's too ambitious. But again, we've got to remind ourselves that property doesn't move in a straight line basis. So really you want a mixture of income and capital. Don't go too heavy for income. You want a mixture of both to make sure the portfolio is going to ride out the bumps along the way, which is a good segue into property. Because as I said, the client wanted to sell Ashgrove when in 2017 when we started working together. The client purchased it in 2007 for $550. So really the first 10 years of owning that asset, it only increased by about $200,000. And again, over the last 7 years, it's more than doubled in value. So again, it's really about being conscious of cycles. I was very conscious of the Queensland cycle in 17. I said around the end of 18, it started to move into a growth cycle, but it had been in a flat cycle for, almost that entire period that the client owned the property. So kind of completely messed up the timing. But if you hold it for a flat cycle, then hopefully you can hold it for another full growth cycle. And if you do that, on average, your returns should be closer to the long-term mean or average, median, I should say. So it's really about being conscious of those growth cycles and being patient as a property investor. When property really kicks off, it really kicks off. Active management, I think that was as I reflect on the case study, having those two active funds, it's not an easy decision, as I said, to sell an asset that's been historically performing well, but we shouldn't really let past returns handcuff us to or influence our decisions that we're making today. They're important to take into account, but we shouldn't be really dictated by them. So it's entirely possible that future returns will be completely different, and we're really trying to decide about future returns. That's really our focus when we're looking at a portfolio. So having the fortitude to really stick to a rules-based methodology helped us make that decision really, and ultimately, as we look back, it was the right decision to make. And lastly, diversification is really important and difficult to do in the short term. And I would say only working together 7 years. That's getting medium term now, I guess, but it's not a huge amount of time. And, as I alluded to, over the time that we've been investing together with this client, we went income equity strategy. Then the government introduced this banking super tax. The banks got smashed, the financials tend to make up a large portion of those high yielding ETFs. So that didn't really work out for us. We've had during COVID, particularly when interest rates started to rise in mid-22, the value of bonds got smashed, just because the market wasn't really expecting so many rate increases, particularly at the time RBA was saying it wouldn't increase interest rates until 2024. Obviously, that was wrong. We've had infrastructure. We look to invest or increase the portfolio's exposure to infrastructure back in 23. Didn't really perform so well in 23, but it's had a stellar 24. So, these sorts of things that we've made changes to this client's portfolio in order to introduce better diversification across multiple different asset classes. Unfortunately, in the short term, these clients warn a little bit of volatility, almost all of it unforeseen, because of course, if we knew that volatility was coming, we wouldn't have made the decision. But in the longer run, as more time elapses, the client is in much, much better situation because he's got that diversification. And if one of those asset classes doesn't perform, it's no big deal. We've got plenty of fingers in plenty different pies. But in the short run, the timing around making those decisions has a really big impact on returns. Like you mess up the infrastructure decision, and that was really around interest rates. In 22, 23, we were investing in infrastructure. Then interest rates went up and that hurt that asset class. It wasn't terrible. It was just not as good returns as we expected. As I said, they had double-digit returns in 24 for something that is a relatively defensive asset class is a pretty good outcome. So I thought it was a good case study to share with you guys, just so people understand, how do you build these portfolios and how do they perform, and how do you get to something that's going to be a perpetual portfolio. And of course, if we reflect back, good on the client for reaching out to us in 2017, when he realized that, he's getting to a stage of life where making really important investment decisions was critical. And I'd argue it's always critical. And then most importantly, following that advice, and he has followed the advice and allowed us to be able to make those changes on his behalf. And I think he'd reflect over the last 7 years as being a pretty good outcome. Okay, well, let's get into some questions then. First question is from Jack. Jack writes, I was made redundant on my 60th birthday and moved into pension phase in my self-managed super fund. 3 months later, I got an offer to go back to work, which I took. This year, I have to pay 4%, around $30,000. Should I recontribute it back into the self-managed super fund or put it in my offset account against my personal loan, which attracts an interest rate of 6.43%? Hard to give advice, and I don't give advice in this podcast. Of course, it's really observation and information, not personal advice. But Jack, I guess the question is where you're going to get the highest return. So if you put it in your offset account, your return is guaranteed. That's the first point. You're always going to save interest. That interest is non-tax deductible, assuming it's a home loan. So your after-tax return is 6.4%. If you put it back into your self-managed super fund, if you remain in pension phase, you don't need to worry about tax. But if you convert it back to accumulation, you're going to pay 15% tax. Not that big a deal. But the returns aren't guaranteed. So if you're going to take that risk, what return do you really need to be able to earn to compensate you for that risk? Well, if the risk-free return is 6.4, let's call it 6.5%. I reckon you'd want a risk premium maybe of at least 2%. So you're looking at, you really need a return of 8.5% to kind of make it worthwhile. It's entirely possible, but after a couple of years of great returns, I would say we're closer to a period of time where we're going to get below average returns. And I think parking in your home loan is probably the best way to go. But I don't know what other assets you have. I guess I can imply your super balance from what you've told me, but I don't know what other assets you have and how much debt you have and what your income is, all those sorts of things. Okay, next question is from Leonard. Leonard writes, I've been a long-time listener and must say the Q&A episodes are a really great addition to the podcast. Thanks, Leonard. I think they're excellent too. I mean, I love the questions. They're always very thought-provoking, so I'm glad you're enjoying listening to them. Your book, Investopoly, I would also say is the best finance investing book I've ever come across, and really appreciate you breaking down the fundamentals to simplify the secrets of success and eliminating all the noise. Thank you. Well, thank you, Leonard. I appreciate it. I have a couple of questions. I find episode 331 a little perplexing when you said the low income, a 1.5% yield, high growth property, the growth of 7.5%, call it property A, is better than the high income, 6% yield and 3% growth, property B. When the latter has a higher internal rate of return, 11% on B versus 10.5% internal rate of return on A. If I understood you correctly, your conclusion to claim that property A is better despite the lower internal rate of return is the net gain based on a 30-year mark of $2.8 million in cash versus only $520,000 on property B. Why is your conclusion only based on the net gain at the end rather than the cash flows and outflows across the entire 30-year journey, which essentially is what the internal rate of return is supposed to account for? To put the question another way, if there were two investors, investor A and investor B, and both started with a certain amount of money in the bank on day one, say $500,000, which investor ends up with more cash in the bank at the 30-year mark? In answering this question, can you please also assume that the cash surplus when the property turns positively geared is reinvested in balanced assets with the same 9% return? Look, it's a good question, Leonard, and thanks for making it, because it's actually an important observation. And maybe what you've done here is pointed out a shortcoming in my episode, really, because I should have explained it well enough. So you're right, the internal rate of return really measures the annualized compounding return that I've achieved from the series of cash flows that I've made, or the contribution that I've made. And when we go and buy an investment property, typically we'll go and borrow the full cost, including stamp duty, so forth, no cash. I don't put any of my own cash in. And the only cash that I contribute is then to the holding costs. And so if the low yielding property that's going to cost me a lot more money, I'm going to put more money into that asset because that, as I said, the cash flow cost is much higher. And it will be negative cash flow for most of that 30-year period probably, versus the high yielding property. I'm going to put firstly a lot less cash in because the yield's higher to begin with, but also it starts to turn positive a lot sooner than the low yield property. And so at some point it's going to give me cash back, as you alluded to. You're going to get a return and you can put that money elsewhere. And the reason that the low yield property wins, or I say it's better, even though the internal rate of return is 10.5 versus a high yield 11, is exactly right, because it's going to give you $2.8 million in your pocket at the end of the day. And the reason for that is that you've put more money in, right? Even though the return is 0.5% lower, internal rate of return is 0.5% lower, you still end up with a lot more money in the bank because that property has cost you a lot more money. So theoretically, you would be better off if we're comparing 2.8 million of cash versus $500,000 of cash for that high yield property. Theoretically, you should buy 6 high yield properties. And because the internal rate of return at 11% is higher, that is the best outcome. Like mathematically, that's the best outcome. And if you had 6 of those properties, you would have about $3 million of cash. If they all generated $500,000 after you sold them, pay for all the taxes, repay the loan, all the selling costs, etc., exactly like I talked about in that episode 331, that would be a better way to go. But the problem here then is borrowing capacity and risk and exposure. Because if you're going to have, remember, I'm comparing the same asset value in that episode, just different components of return. And so I can't remember the asset value. I probably would have just chosen $1 million in terms of, so you can either buy one low yield, high growth property, $1 million, or you can go and buy 6 $1 million high growth, high income, low growth properties. Well, you're going to have the borrowing capacity to be able to do that. And that's not always doable. Most people that's what they're working with, a limited amount of borrowing capacity. And there should be a way where we can analyze that to make that a little bit clearer. But Lena, hopefully that makes sense to you and everyone else in terms of why I said that asset was better. And look, we're making some assumptions here in these calculations. So we're comparing internal rate of return of 10.5 to 11%. Let's not split hairs here. I would just say they're broadly the same internal rate of return. I don't think it's not that we're making assumptions that could very much change. Let's not say that that's an exact calculation. It's really ballpark. I would call them relatively the same. Now, Leonard offers a second part to his questions. I'll paraphrase. He said, well, what about a different option being an occupy option? So what if they bought the family home, lived in it, don't pay any capital gains tax, obviously don't get any income, nor do they get any negative gearing, but save on tax. Well, Leonard, I have recorded an episode last week where I looked at the negative gearing, say in super versus and no capital gains tax, versus owning a property outside of super where you get the negative gearing, but you've got to pay the capital gains tax, and they netted each other out. So if you've got no gear, and that was with 15% gearing benefit inside super, if you take the gearing benefit out, the internal rate of return is going to be worse, even though you don't pay any capital gains tax, obviously, with your main residence. So Leonard, that would be an inferior option, and I've sort of lean on those calculations that I did last week in that super episode. Leonard's got a couple other questions. He asked about if you borrow to make super contributions, is the loan tax deductible? Answer's no. Whether you make concessional or non-concessional contributions into super, if you borrow to do that, it's not tax deductible. I would say, Leonard, I have recorded a video over on YouTube about superannuation borrowing to make super contributions. Maybe check out that video where I talk about maybe there's some circumstances you would do it, but it's not a widely used strategy. And Leonard's last question's about utilising a capital loss. He's got a capital loss from a previous property investment that's been sold. And he's asking, he's made another investment to replace that, hopefully a better quality one. And he's asking, how do I use that capital loss? Well, the capital loss you can carry forward indefinitely. When you do make a capital gain, that capital gain, you can reduce that capital gain by your carried forward loss. And after you've done that, that's your sort of net gain, if you like. Then you apply the 50% discount. So it's offset before you apply any discounts in order to calculate your capital gain. And the loss should be able to be carried forward indefinitely, but certainly get some advice from your registered tax agent. Okay, I'm really keen to keep these episodes to around about half an hour. Hopefully that makes them sort of easier to consume. So I'll leave it there and look forward to speaking to you tomorrow. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.